Happy New Year! I'm Mario Becker from Das Family Office. We've just released our Reflections 2023, and in the following video, I'll summarize the main aspects and prepare an outlook for 2024. I hope you're enjoying this. I'm really happy because all our clients have made very good money in 2023, which is very important for us as fee-based advisors because our interests are closely aligned with those of our clients. We're not earning money by selling products, but we're making money by helping the clients to make money. So today and 2023 was really good for us. Overall, 2023 was much better than expected, despite the fact that we had a lot of political crises, a continued war in Ukraine, then a new war is basically starting in October, and ongoing high levels of inflation. But despite that, we've seen very strong equity markets in the first half until about mid-July, and at the same time also very strong bond markets, which was very surprising because inflation was still more or less elevated. We think that the reason for better bond markets was the fact that 2022 was really bad, extremely bad, and valuations were probably too attractive to forego despite higher inflation rates. The same for equities. We've seen a really bad Nasdaq 100 index in 2022. Overall, global equities had a really bad time, and I presume that lower valuations, more attractive valuations, brought buyers in the picture. At the same time, the technology industry or the technology sector got really excited about the opportunities of artificial intelligence, which is why stocks like Nvidia or other stocks of the so-called Mighty Seven, Apple, Amazon, Alphabet, Meta, Microsoft, Tesla and Nvidia were driving these large cap indices. And we could see this very clearly in the Nasdaq 100 index, but also in the S&P 500 index, as well as the MSCI World Index. So we've seen high double-digit returns. Yeah, this was really exciting, but also very unexpected. In our half-year review, I was actually talking about overly good returns or unexpectedly good returns that may not last. And sure enough, we received a cold shower in the period from effectively mid-July until end of October, where more or less all the winnings, all the gains of the first half were lost, especially in the bond market, but although in the small cap area, and pretty much all global equity markets except for these Mighty Seven stocks. This was truly disappointing, and I do remember that a lot of our clients were contacting us in October, early November, let's say more October, wondering what was going on. They had seen their half-year reports, they were very happy. Then they saw all of these winnings disappear. Obviously they were unhappy. We were also not happy. This is unfortunately part of our world. But what we also didn't expect was what happened afterwards, effectively in November and December. We've seen a 180-degree turnaround. I remember that in our webinar somebody was asking whether we could imagine that this year would end well after all. And obviously, as always, I don't know what the future holds, but we were saying that bad periods are typically followed by good periods, but we would have never imagined what happened in November and December. And similar to our experience of mid-year last year, we actually think that it was probably too good to be true, because what we've seen was a massive recovery in, again, the Nasdaq 100 index, which closed the year at 55%. Then global quality equities, the ones that we typically recommend, the ones that are following, or better say the managers and the indices that are following Warren Buffett, in that they are selecting companies with very high returns on capital, very low debt, very high command of the market overall. They did exceptionally well, and they recovered all of the losses of 2022 and more even. In addition, even small cap stocks did very well. They had a really bad period until the end of October, but did phenomenally well in November and December. So pretty much all market segments were moving really well, with the exception of China, which had a third losing year in a row. But China, as we've mentioned several times, has a particularly different situation from the rest of the world, and we've been advising against putting too much exposure into China. But it's really possible that markets went too far too fast in November and December, because the first couple of trading sessions in the new year have been on the negative side. I wouldn't be too negative now. Some people say as the first week goes, so goes the year. It's still very, very early in the year. The positive sentiment at the end of the year had their reason, because they were solidly founded in the fact that inflation is truly coming down, that core inflation rates are now below the central bank reference rates in Europe as well as in the US. So there is merit to the price movement then. At the same time, valuations were attractive. As we're looking at the market now, we have to discern between market segments. Overall, global bonds and global stocks are still truly attractive. The long-term inflation expectations as measured by the break-even yields, they're about 2% plus. And if we look at that, we can see that both in the US dollar as well as in the euro, bond investors can really enjoy real interest rates. That means inflation adjusted, they do earn between 2 and 4%, which is something we haven't seen since 2007. The only segments, or let's say the only markets that appear really expensive is India. Indian equities have had another good run, in as much as China had 3 bad years in a row, India had 3 good years in a row, and we've been advocating Indian equities for a long time. But now that that seems to have become a mainstream opinion, and we wouldn't chase this market. We would, of course, we hold existing positions in India, but for new exposure, we would wait for a bit of a consolidation or for better valuations overall. They may arrive through a correction, or they may also arrive through higher company earnings. We will see. We're in no rush. India also has an election, the same as the US. The US are having an election on November 5 this year. And typically, US election years are years that are generally good for financial markets, because I guess the candidates are making a lot of promises, and the market is kind of trying to anticipate these promises. At the same time, they're typically accompanied by higher volatility, and we can easily foresee that for 2024. So it may become a bit more volatile this year. Higher volatility will also be a function of the fact that we still don't know whether inflation has been truly defeated or whether there will be bouts of inflation coming back. So I foresee that every announcement of inflation data will trigger a lot of buying and selling in anticipation of this or the other outcome, and that will produce volatility. Bond yields, as we mentioned, are very attractive across the board, across the yield curve. Then equity risk premia are also very attractive. We can see 6 to 7% or even more, depending on the market, with the exception truly of US large cap, the Nasdaq 100 index, India, and also the MSCI World Quality Index, because these indices and these markets have been driven by the mighty 7, and there's a chance that they won't do so well this year. We would continue to be very careful with investments in China, because there's a lot of uncertainty, and we just don't see how that could change. Even if valuations may be low, and there may be times when there will be little rallies, but we don't think that these rallies will be sustainable. So we're quite fortunate that our clients don't hold a lot of China exposure, and we will certainly not add to it. There's just no reason to think that things can be different anytime soon, and there are enough other opportunities in the market for this year. So where do we see the opportunities in 2024? Obviously, we always advocate the fair horizon concept. That means depending on your investment time horizon and your cash flow situation, you should increase the equity exposure as you increase the investment time horizon. So that means long-term time horizons should mean heavy equity allocations and equity risk allocations. And short-term time horizons, that means if you need your money very soon, you should stay with short duration bonds and be very careful with equity investments. If we're just looking at certain markets, we can see certain valuations that look really appealing from a short as well as a long-term perspective. And here I would like to mention US small and mid-cap stocks. They're trading on only 11, 12 times earnings. This is truly cheap, and we haven't seen such a gap between the S&P 500 and the S&P 400 and 600 in such a long time. So this appears to me as if they're great opportunities. The same goes for global small cap stocks. Again, here we would like to look at our managers, be they index building blocks or be they actively managed. And we see good opportunities here. Some of you may say, yeah, you've been promoting small caps for a long time. That is true. They've had a terrible 2022. They had a decent 2023, but valuations are quite low. And I think there could be an opportunity this year. That's not to say that you have to do this. And I would also not recommend putting more than 20% of an equity allocation in a portfolio. But fundamentally, it seems to be a good idea, because in the long run, smaller company stocks can beat large company stocks, but it comes with volatility, and that's not everybody's beef. Yeah, you don't have to do it, but to me it looks like a good opportunity. We also like Asia ex China, because China seems to be the only troubled market in Asia, even if it obviously influences other markets. But we like Japan, we like Vietnam, we like Indonesia. But fundamentally, I prefer to buy Asia as an Asia ex China approach via a manager. So I'm not particularly in favor of picking individual countries, but we have building blocks for countries as well as the region. So take a look. Global bonds are attractive, as I mentioned before. There are real yields to be had across the yield curve, and we haven't seen that since 2007. So from a portfolio construction perspective, it's actually a very good market because we're getting paid in both bonds and stocks. So it's really great to help our clients build portfolios, because we can really choose from good ideas and create portfolios that make a lot of sense. I'd also like to highlight Tier 1 capital, or COCOs. Normally, I'm not particularly fond of this asset class, but because of the crisis of Credit Suisse, they became very cheap last year. And I would say there's still a little bit of fuel left in the tank. Again, that's not to say that you have to now load up on COCOs. But if you like higher income with equity-like returns, this can be something to consider. Last not least, I've just been highlighting a few ideas. Please take a look at our quarterly publication reflections. As it says, every quarter we're publishing this. We're highlighting a lot of opportunities. At the same time, we're reviewing building blocks that we deem attractive for portfolio construction. If you don't know us yet, please reach out to us. We really enjoy having our client dialogue. And yeah, as mentioned earlier, we're a fee-based advisor. That means we're making money when our clients are making money. This is very different from the bulk of the industry players. Most financial service providers are earning money by selling products. We're very different. We're proud of that. And with that, I wish you a wonderful 2024.